It's the 1970s. Americans are waiting in endless lines at gas stations. Inflation has soared above 10%, unemployment is climbing, and the stock market, a lost decade. This toxic mix of rising prices and stagnant growth would soon be known by a new word: stagflation. Now fast forward to today. The US has just emerged from the pandemic with one of the strongest recoveries in decades. Yet cracks are showing. Inflation hit a 40-year high in 2022, peaking at over 9%. The Federal Reserve jacked up interest rates at the fastest pace since Paul Volcker's shock therapy of the early 1980s. Housing has become unaffordable for millions. And while unemployment remains low, productivity growth has stalled, and consumer debt is at record highs. The question practically asks itself, is America heading back to the stagflation nightmare of the 1970s? For most people, stagflation is just another scary economic buzzword. But economists know it's one of the most devastating scenarios. Because unlike ordinary recessions or inflationary booms, stagflation is a no-win situation. Normally, if prices rise too fast, the Fed raises rates to cool the economy. If growth slows, it cuts rates to stimulate demand. But with stagflation, both problems, high inflation and low growth, hit at once. Every policy lever risks making one side worse. That's why the 1970s still haunt policymakers. And why today's echoes feel so alarming. In the 1970s, US inflation peaked at nearly 14% in 1980. Growth sputtered, with GDP contracting in multiple years. Unemployment reached 9%, stock markets delivered zero real returns for a decade. Now compare. In 2022, inflation in the US peaked at 9.1%. That's the highest since, yes, the 1970s. By mid-2024, it cooled back closer to 3%, but only because the Fed slammed the brakes on the economy with interest rates above 5%. Mortgage rates more than doubled, choking the housing market. Credit card debt crossed $1.1 trillion. Consumer sentiment fell to levels usually seen during recessions. Does this sound familiar? Inflation that's too sticky. An economy that looks strong on paper but feels weak to households. A Fed stuck between political pressure and economic reality. The parallels are hard to ignore. In the 70s, the oil shocks triggered stagflation. First in 1973, when OPEC imposed an embargo, quadrupling oil prices. Then in 1979, after the Iranian Revolution. Energy is the lifeblood of an economy. When oil prices spike, everything, from transport to food, gets more expensive. Today the triggers look different, but the pattern rhymes. The pandemic shattered global supply chains, sending shipping costs up 500% in some routes. The war in Ukraine spiked global energy and grain prices, and climate-related shocks, from droughts to hurricanes, keep stressing food supplies. Energy again is central. Europe scrambled for gas after cutting off Russian pipelines, while the US saw gasoline hit $5 a gallon in 2022. This isn't the 1970s, but the resonance is undeniable. But perhaps the most striking similarity lies not in the data, but in the psychology. In the 70s, Americans lost faith in policymakers. The Fed seemed powerless. Presidents Ford and Carter looked overwhelmed. People felt trapped in an economy that punished both work and savings. Today, you can feel that same unease. Polls show a majority of Americans believe the economy is doing worse than official numbers suggest. Despite low unemployment, nearly 60% of households report living paycheck to paycheck. Trust in the Fed is near historic lows. And in a polarized political climate, inflation has become not just an economic fact, but a cultural and partisan battleground. Are we repeating the 1970s, or just seeing a faint echo? To answer that, we must look under the hood. What caused stagflation back then, and do those same forces exist now? Start with the 1970s. Economists point to two big problems working together. In 1973 and again in 1979, oil supplies were hit hard by geopolitical events. Oil prices jumped almost overnight. Because energy touches everything, transport, factories, and food, those price jumps spread quickly through the whole economy. Costs went up, people's pay didn't keep up, and output slowed. That combination, rising prices and weak growth, is the classic path to stagflation. But oil wasn't the only cause. Back then, the central bank, the Fed, sometimes let inflation slide. People started to expect prices to keep rising. When that happens, workers push for higher wages to keep up, and companies raise prices to cover higher wages. That loop, higher wages, higher prices, higher wages, made inflation stickier. In the end, the Fed under Paul Volcker had to hit the brakes very hard, big rate hikes, to stop the cycle. That worked, but it caused deep recessions and a lot of pain. Now compare that to today, after the pandemic. There are echoes of the 1970s, but the story is also different. During COVID, many factories and ports shut down. Shipping costs shot up, and when people started spending again, demand for goods rose fast while supply was still broken. That mismatch pushed prices up, much like a supply shock does. Then the war in Ukraine added another shock. It pushed energy and food prices higher in 2022. Europe scrambled for gas and global grain prices jumped. These events weren't exactly the same as the OPEC embargoes, but they acted like supply shocks. They raised costs and raised prices at the pump and in stores. Still, the similarities have limits. Today's economy is more focused on services and technology than the 1970s economy, which relied more on energy-intensive industry. Many parts of the modern economy, software, cloud services, don't get more expensive just because oil prices rise. Also, the Fed today has stronger credibility. It has a clearer history of fighting inflation, and it communicates its plans more clearly. That makes people less likely to expect runaway inflation, and that expectation itself helps prevent wage price loops. The labor market is different too. Union power was stronger in the 1970s, which helped push wages up across whole industries. Now unions are smaller, so wage increases are more uneven. But after the pandemic, tight job markets gave some workers more bargaining power in certain sectors, creating pockets of higher wages. A partial echo, but not a full replay of the past. Another big difference is the fiscal policy. The 1970s mixed big government spending with a Fed that didn't always act forcefully against inflation. The pandemic era saw huge, fast fiscal stimulus in 2020-21. Money that boosted demand while supply chains were still broken. That pushed inflation higher too. Crucially, the Fed reacted quickly with aggressive rate hikes in 2022-23, partly because policymakers had learned lessons from the 1970s. So, the picture is mixed. Today we have supply shocks like shipping problems, pandemic shutdowns, war-related energy moves, which look like the input shocks of the 1970s. But they hit a different economy, one with more services and tech, weaker unions, and a central bank more willing to fight inflation. Why does that matter? Because those differences change the policy trade-offs. In the 1970s, slow or weak responses let inflation expectations drift and made things worse. Today, central banks acted faster, but political pressures, elections, partisan calls to cool inflation without a recession create new limits. This brings us to the key question. Given these similarities and differences, what scenarios might follow, and which policy choices will decide whether the US slips into prolonged stagflation or avoids it? Scenario A, stagflation light, most probable. This is a drawn-out period of slower growth and above-target inflation, but not a replay of the 1970s ruinous double-digit inflation. Think 1 to 2 years of real GDP crawling near potential, unemployment drifting up modestly, and inflation decelerating towards, but stubbornly above, the Fed's 2% goal. The BLS's August 2025 CPI print, around 2.9% year-over-year, and a still tight but cooling labor market point to a situation that's easing from the 2022 spike rather than exploding anew. At the same time, the unemployment rate has risen to roughly 4.3% in August 2025, signaling that slack is gradually returning, but not at crisis levels. Why this scenario is plausible? Inflation drivers today, shipping snarls, war-related commodity volatility, tariff shocks, are large but discrete and in many cases reversible. Central banks have stronger credibility now. The Fed moved quickly in 2022-23 and has signaled readiness to tighten or loosen depending on incoming data, and markets generally expect a soft landing. Recent commentary from the Fed and other institutions suggests policymakers are shifting focus from fighting inflation hard to guarding against weakening employment, i.e., the balance is tilting away from panic and toward gradual normalization. Scenario B, a true stagflation redux, low probability, high impact. This is the doomsday. Inflation re-anchors upward, wage price spirals emerge, growth collapses, and the Fed faces painful choices. For that to happen, several unlikely things would need to coincide. A prolonged deep supply disruption, e.g. widespread energy embargoes or geopolitically triggered commodity blockages. A political breakdown that neuters central bank credibility, and a sudden spike in long-term inflation expectations that feeds into wages and contracts. It's possible, but the pieces are harder to assemble today. Monetary frameworks and communications are stronger, unions are weaker than in the 1970s, and the economy's structural tilt toward services and high-productivity tech makes broad-based, persistent cost-push inflation less likely. Still, rising household leverage, total U.S. household debt hit roughly $18.39 trillion in Q2 2025, makes the population more fragile to policy mistakes or shocks, raising the social and political cost of any aggressive central bank response. Scenario C. Soft landing. Inflation returns to target. Best case. Here we get a careful, data-dependent Fed. Supply lines normalize, tariffs and pandemic tailwinds fade, and inflation slides back toward 2% while growth steadies. The Fed's current policy range, which sat in 2025 around the mid-4% area, gives it room to pause, assess, and nudge rates either way as labor market signs change. That institutional flexibility, combined with the economy's resilience, makes this outcome entirely plausible. Policy trade-offs that decide the outcome. First, monetary policy. Credibility. If the Fed is perceived as willing and able to act decisively to anchor inflation expectations, wage price dynamics are less likely to take root. Second, supply-side policy. Tariffs, trade frictions, and energy policy can either amplify or dampen shocks. The IMF and other institutions have flagged that tariff-driven price volatility and weak hiring complicate the Fed's calculus. Politics is directly feeding the economic risk set. Politically, the stakes are huge. Election year pressure to lower rates or shield voters from higher prices can weaken the firewall around central bank independence. If markets sniff political interference, borrowing costs and risk premia could rise, precisely the recipe that turns a manageable slowdown into a crisis. If you want one practical, defensible posture for the next 12 to 24 months, it's this. Prepare for inflation variability and growth uncertainty at the same time. Protect purchasing power. Consider a modest allocation to inflation-protected securities, TIPS, or real assets, a diversified real estate exposure or commodities via funds, rather than betting everything on cash. Trim high-cost debt. Carrying large balances on credit cards or adjustable-rate consumer debt is riskier if inflation accelerates or rates rise again. Reducing revolving debt improves optionality. Total revolving debt and credit card balances are notable pressure points in 2025. Diversify income exposure, skills that are portable and in demand. Tech, healthcare, trades, reduce exposure to cyclical layoffs. Small business owners should stress test margins for rising input costs. Maintain liquidity. Keep an emergency buffer. Market dislocations can be rapid even if broad macro indicators look stable. Invest with humility. Equities can still perform in stagflation-light outcomes if earnings growth holds, but favor companies with pricing power and balance sheet strength. A full 1970s-style stagflation shows up in the history books as the result of very specific institutional failures. Unchecked inflation expectations, repeated oil shocks, and an accommodative monetary framework. Today, those exact conditions are not present. The smarter, evidence-based reading is this. Stagflation light is a real near-term risk, slower growth plus sticky inflation pockets. But a replay of the 1970s is unlikely unless policymakers lose credibility or an extraordinary supply shock reappears. That means your attention should be on policy signals. Is the Fed hawkish enough to keep expectations anchored? And structural policy changes, trade barriers, energy decisions, and fiscal choices. Watch those, not just the headlines, and position portfolios and household finances for uncertainty rather than certainty. Because history rarely repeats perfectly, it rhymes. And right now the rhyme is worrying enough to matter, but not yet the same song.